Hello, everyone. Welcome back to How to Trade and Switch Markets. I'm Shane Vernier, and this is the week ahead. Today, we're going to talk a little bit about what's coming our way. We're going to review a trade idea from Friday. We're also going to take a look at how to draw Fibonacci retracements properly. It's going to be a very quick and brief tutorial. And then also, I had some great questions really in the live chat before we started today over at How to Trade. So there's a lot going on this week. There's a couple key events. I mean, last week, let's be honest, dog days of summer. It was absolutely quiet. There was nothing really happening as far as news or anything like that. And this week is going to be the complete polar opposite. I expect major fireworks across really all the markets. And I think that we're in for a light show. So if you guys like roller coaster rides, if you like up and down, if you like sporting events, this is probably one of the weeks for you. I think that it's going to be fantastic. So I'd like to start off by welcoming everybody back to week 30. What is this, week 33 already? Can't believe this is the 33rd time we're doing a Monday for this trading year, but a lot of familiar faces, a lot of new ones. T. Marina, good to see you, T. Welcome. Samson, good to see you. First time here. Hello, everyone. Hello, Samson. How are you? I'm confident you're doing well. We're going to go over some key markets. If there's any questions that anybody has, be sure to throw them in the live chat. This is all about engagement. It's all about helping you become a better trader. I will give you my trade ideas, sort of show you my methodologies, maybe a strategy or two, and then also we will get on to the news of the day and the news of the week. And boy, there is some big news. And Mondays are great for strategizing, great for game planning. I'm going to tell you the key events this week and what you have to watch for. And remember, if you're a client of Switch Markets, you will be getting our Switch Markets newsletter beamed out to you early tomorrow, probably in time for the UK session. So you're definitely going to want to stay tuned to your email inbox. I'm going to give you some picks to click and also some nice write-ups for what to expect here this week. So good to see everybody back. Let's see, JC, good to see you. JC, Lita, Andrea, good to see you. Always a pleasure. Let's see what else we got here. Samson and T. Marine, already talked to you guys. All right, guys. Let's go ahead and get on with it. I think that it's been an interesting day already. I want to start off with a very quick question, though, that I received in the private chat. Shane, they watched the trader really liked my email, or excuse me, the Fibonacci retracements. Also liked the Counterpunch series that's in the How to Trade trading room. For this, I'm going to keep this real simple. The question was, Shane, why do you draw Fibonacci's the way you do, and how do you do it? And I'm going to say it's really simple, guys. I work from the most current spike to the most current spike. And what a spike is it's this formation right here. It's a 3-bar formation. So a spike low would be a situation where the second bar is lower than the first bar and also lower than the third bar. That would be a spike. I call that the lower extreme. That's in an uptrend. That's where I want to start my Fibonacci's. Okay, so if we're going to go ahead and start the Fibonacci retracements here, where are we going to end them? I would go to the spike high, the most current spike high. Now we're talking about, we're really, again, a 3-candle formation. That spike high is going to be higher. The upper extreme is going to be higher than the the first bar, and then it's also going to be higher than the third bar. That's going to give you really your zero level for your Fibonacci. So right here, what are we going to do? We're going to go right there with our 100 level, and then all the way up to our zero level, and then we're just looking for pullbacks in an uptrend, and it's the absolute opposite from a downtrend. So right there, very simple, guys. Most recent spike to spike, and as you can see right here, what do we have? We have Bitcoin back at 120. Very, very confident that we hit that 125 threshold relatively soon. Very, very bullish here for crypto early in the week, and I think that's always big. We watch crypto as sort of a signal for what risk assets are doing, and right now risk assets are looking pretty good, even though the Dow's off a little bit, the S&P's flat, the NASDAQ's flat. This isn't bad action for a Monday. We're not seeing a big sell-off, and there's a couple of reasons why we're not seeing it. So right there to start off with Bitcoin, that's going to be a good illustration of how I would draw my Fibonacci's in an uptrend. If you want to go ahead, remove those, and I can go ahead and show them to how I will show you how I would draw them in sort of a pullback or a downtrend. This would be essentially it. There's your spike high. It's higher than the first bar right there. It's also higher than the third bar. That would probably be what? My 100 level, and then my 0 level is going to go down to that spike low. Very simple. I like simple. Simple's good. So I hope that sort of squares it away. I hope that answers your question. Pretty interesting market in Bitcoin, though. We're going to get back to crypto here in just a second. So welcome to the Switch Markets community. Remember, we're trying to meld. We're not trying to do anything. We're doing it. It's just a little bit, it's definitely a work in progress. We've got some major changes going behind the scenes. We're going to be bringing you a lot of content. And I'm not going to say that it's going to be this month, but probably September, October, November. You're going to see a tremendous amount of content on the Switch Markets YouTube channel. channel. You're also going to see a tremendous amount of resources coming online for the Switch Markets Brokerage. AlgoBuilder.com. I was told about Algo Builder. We got exciting news on that front. Probably talk to you about that tomorrow. We've also got this new reverse KYC program where you don't have to wait to go through the KYC. You can just have a $2,500 deposit and be able to trade right away before your account is even approved. That's a fantastic feature. That can get you up and trading, in some cases the same day. So if in fact you're interested in a forex broker, a CFD broker, take a look at Switch Markets. They're worth looking at. Also, I had a great question earlier today. Shane, do you know any brokers in the UK that use TradingView for forex and CFDs? And I said, well, I'm not overly familiar with the brokerage landscape in the UK. I know the big dogs like everybody does, but I'm here in the United States, so I'm looking more along the lines of United States brokers, futures brokers, stock brokers, things like that. But as far as if you want to use TradingView, you can use it with Switch Markets. You just go with Pine Connector. We made a video on the Switch Markets channel about Pine Connector. I show you how to get it up and running. It's a very simple process. You just have to spend a little bit of time, and you can go with your TradingView analytics and get your trades placed automated essentially on MT5 through Switch. We're excited about that. We really think that's going to grow in the next several years. So those are resources that can help you get up and going with your Switch Markets and get you trading right away. Okay, enough of that stuff. Week 33, 2025, Monday. Today is quiet. We don't have much on the economic calendar. We've got some T-bill auctions that we're going to talk about here in just a second. Tomorrow's the day. Tomorrow's the big day, the big dog, U.S. CPI. We're going to be trading CPI live. I'm going to be back in the saddle in about, 19 hours from now. So this is going to be a lot of live streaming this week. So settle in, get the popcorn, get your trading accounts going and get ready to roll because we're doing U.S. CPI live tomorrow. It's an early one for me, but I can't wait to get it started. That's the big event. We've also got the RBA. The RBA is breaking during the overnight. They're expecting a little bit of a rate cut. We're going to talk about that too. We're going to look at our Aussie pairs. Wednesday, EIA crude oil inventories. That's a nice release. I love that on Wednesday. Typically, that's the backbone of my Wednesday trading with U.S. oil. Thursday's U.S. PPI. That's a monster release. We're going to be watching PPI very, very closely. Friday's U.S. retail sales. So a big week. Big week, and there's a news event out there that we've got to cover, and I'm going to go ahead and cover it after our trade updates. So I definitely want to see up. We got sort of a late arriving crowd. Good to see you. Yes, sir. Good to see you, Patrick. Good evening, good morning, good day, wherever you may be. It's good to be here. It's always good to see everybody. A truly global community, folks, all the way from the UK, all the way out to the Asia markets, down in Australia, and down in New Zealand. So really, truly a global community, and I'm coming to you live from Dillon, Montana, up here in the United States. Let's see, Patrick. Good to see you. Tina Jean. Good to see you, Tina. Dave H. Hello. Good morning. Good morning. Good evening. It's good afternoon. Well, it's still good morning for me, but it'll be afternoon here in about another hour. So that's great. Great to see everybody. Let's see. Tina, big day tomorrow. Absolutely. Absolutely. Big day is going to be CPI. CPI is everything, and we're going to cover CPI. I'm going to get you previewed and ready to rock and roll on that in just a second. Dave F19, good to see you. Hi, Shane and fellow traders. Hello, everybody out there. Let me see. Tina placed a short on the Euro USD, and it's going well, but not sure how low it could go. Shane, please advise. I can't advise anybody of anything. I'm just a simple trader, trading education, trading coach. But I tell you what, we will pull a chart on the Euro USD, and I'll take a look at maybe some key levels we need to be aware of. A big momentum week ahead, absolutely right. Okay, let's start off with this right here. Russia-Ukraine deadline looms. Interesting news on that front. We're going to cover that in a minute. And then the FTSE London session, FTSE back in play. I was really looking to buy a pullback here. I loved the way that the Great Britain pound had driven bearish participation, that really hawkish vote out of the BOE drove that participation, and we were looking to grab a nice retracement buy here. I wanted it Friday. I really did. I wanted it Friday intraday, and right now the market's sort of reversed away from us, but we're still very much in the running to get this trade. So essentially what we're looking at here is about a 9,000 level, somewhere down in there for this FTSE 100. We're looking at that 9,000 level to be a bid at some point. Now, you're up around 9,128, and the thing about the FTSE is it doesn't move like the NASDAQ. So, if I was looking honestly, if I was saying, okay, it's only 125 points and we were trading like the NASDAQ or NQ futures, I'd say, geez, we're right there. We're not right there. This trade could take some work. I love this weekly dynamic, though, and just going back to our Fibonacci's, right there would be your spike low. Why? Because it's lower than the first bar and it's lower than the third bar. Nice little 3-candle setup right there. Spike low, spike high. Beautiful spike high. I love this spike high, and here's the reason why. You're higher. You're higher than that first bar, which was a run up, but it was a nice red pullback bar, and then you've got some compression. This is potentially an explosive situation, potentially to the downside. That's what we want. Now, we've already rallied 0.37%. 1% on the day. So it's not necessarily going the way that we need it to go for us to get involved in this market. But I still like this FTSE play, and I'm willing to stick with it probably for another few days to see if we can't get that pullback and see if we can get a bid right there on the FTSE. I'm interested in that. I think that could be a pretty good one. And the whole reason why is Great Britain pound has been doing a little bit of work. And you can see right now the pound dollar. This was one of those other questions that I got in the live chat here at How to Trade. And I believe it was Gordon. Gordon put this one out and said, Shane, what do you think about the Great Britain pound USD going down? I said I liked it right back up in here. Really a strong downtrend on the 5-minute chart, very, very short time frames. But this is our 920, our coded 920 EMA. And then look what you had. 9 crosses back up over the 20. Oh boy, there was the buy signal. And then you look right here. What did we have? We were deep into oversold territory. That was definitely a potential buying opportunity, or at least the end of your short position. I'm still thinking about different ways we can incorporate the 920 into live trade management, meaning you took a trade doing something else and then you go down to, say, a 5-minute 920 just to see what price action's doing. I think there's a video there and there's a way to do it, but I don't want to get too convoluted or too difficult. I like to keep things incredibly simple, but there is a demand for some more of those intricate trade management approaches, and it may be that you were short, on a 4-hour chart or something on the Great Britain pound USD, and it looked really great, and then you needed a way to get out of it during that US session. Maybe you go down to a 5-minute chart and look for the crossovers, something that can save you money on potentially not an early exit, but a timely exit. That's absolutely huge. Hamu, good to see you, Hamu. Let me see, please, Euro USD. Yeah, we'll look at the Euro USD here in just a second. Let's take a look at a key event. We are going to be talking a lot about the US dollar. I think that's absolutely imperative for what we need to do this week. Really, all eyes are on the dollar in interest rate expectations and all the different things that come along with them. One of the things that we do pretty much every Monday is we don't have any economic events to speak of. Every now and then we get a PMI number, or maybe I believe we had durable goods a few times on a Monday, but key events on a Monday pretty much are non-existent. We're still trading the weekend news cycle, and we're getting ready for what's coming tomorrow. To me, I see price action today is being largely muted, and the reason why I see that is because CPI is tomorrow. That's a bigger deal than anything that's happened today. So T-bills. Every Monday, they go out on the steps of the Treasury. They have an auction, and the U.S. government auctions off a bunch of debt. Well, it's not like that really on the steps anymore. It used to be. It used to be an open outcry type of a format. Now we're just selling debt basically to banks and foreign governments and institutions that want to hold U.S. debt. So if we take a look at one good barometer of short-term U.S. debt that we can say, okay, what does this mean? What does the purchase of 3-month and 6-month treasuries, U.S. treasuries, mean? And it means folks are managing risk over the next 3 to 6 months. These yields are important. They show us what we think that the Fed and interest rates may do in the coming days. Now, typically when yields rise, we believe what? We believe interest rates are going to go up. Interest rates would go up to restrict the supply of money. So you're going to demand a higher yield for these T-bills. Now, if they go down, we believe that the interest rates are going to go down, and that's going to be more supply of money, so it's going to be less attractive maybe to offer something like this. So 4.150 is beneath 4.165. That tells us yields are down on a 3-month, and then also the 6-month T-bill, 3.970% is beneath 3.98%, which is also down on the 6-month. So that tells us that what? Potentially, we're in for some rate cuts. We believe they're coming in September now. We're going to find out relatively soon. All right, guys, we got Euro USD. They're shouting from the hilltops. Show me the Euro USD. Let's go ahead and start off with this approach right here. I'm going to show you, my Fibonacci's here in a second, and sort of my approach, my own personal approach, the way that I would trade it. But I do sort of want to reference these 920s because they are important. They really do show you what's happening with price action. And you can see right here, your 9 EMA is crossed under your 20. So you're very much in a bearish type of a situation. So as Tina said earlier, placed a short on the Euro USD and it's going well. Yeah, it is going pretty well. Your 30-minute chart's just beautiful market structure. Nice pullback right there, right around 7:30 a.m., which would be 9:30 a.m. Eastern. I'm in the Mountain Time Zone. Don't worry about that. That's opening bell on Wall Street. Nice little bounce. Okay, the dollar got a little bit weaker, and then now the dollar sort of continued the downward trend. So if you're holding a short position, you're probably correct. On an intraday position, you definitely are correct. The question is how far could this market go, and where should we be looking potentially to not necessarily just bail out of it, but potentially maybe limit our exposure to the Euro USD. Well, the way that I would approach that is with my Fibonacci retracement sequence, my 13 EMA, and my Bollinger Bands. It's very important that I stay consistent with my own personal directional analytics. And typically when somebody asks me, Shane, what do you think about a market? This is my go-to. This is what I've been doing for years and years and years. A couple of observations on the weekly that I would be aware of if I was holding shorts or if I was directional period on this Euro USD. Number one, I would want to know where my 13-week EMA is. And it's right there. 13-week EMA. Let's go ahead and color code that blue. Low. EMA, 13 period EMA is 115.32. Okay. What are we trading right now? 116. All right. I would look at that as being potentially not necessarily the bottom of this week's market, but it will be a hot zone. There will be bidders there. I would be shocked if there weren't bidders right down there dug in at like 115 and a quarter, 115.35, something like that. So if we're looking at sort of our macro levels, we would pull a weekly and say, okay, that EMA is a big deal to me. Number two, you're still trading inside of the week of the 28th of July. So, I mean, last week we traded fully inside of that. Now we're trading inside of last week's range. Clearly we're waiting on CPI. So if you guys are trading the Euro USD, you really have to be careful of a couple of things. Number one, you've got to be careful of price action in and around CPI tomorrow, the Consumer Price Index. We will have that live for you. I'll be on at about 6:20 my time, which means this is about a 4:30 a.m. wake-up call for me. That's okay. I don't mind. Money never sleeps, guys. Money never sleeps. But remember that if you're carrying a position into that release, you've got to be incredibly careful because the participation is going to fly into something like the Euro USD, and we're going to get huge volatility. Be sure to check out the live stream. We will be trading that live. I'll go ahead and probably be doing something like a 9 EMA, maybe short-term crossovers as well. I'm not sure just yet. Okay, so what do we got here on the Euro USD? Well, we've got a big bearish day right there, about off 0.33%. We're beneath our 13-day 13 EMA, which was right around 116.13. That's big. That's big. So let's go ahead and draw a Fibonacci retracement sequence for this daily. I don't particularly like it, but let's go ahead and do it just the same. Reason why I don't like it is this is very, very tight right here, 116.99 to 115.28. There's only about, 170 pips there. Very tight. Bounced off of 62% right there at 115.93. All right, so you got an issue right there. You got a nice bounce. But what does this mean? Is this just a temporary bounce or is it a permanent bounce? Well, you're on a daily 62%, so that could be one of those things that we say, well, is that the bottom of today's market? It could be. It could be, but we are moving a bit lower. Once again, I mean, we're all anticipating CPI right now. The traders are actually pricing what they think tomorrow's CPI report is going to be. So if you're in this trade and you're saying, okay, is the U.S. dollar going to come out stronger or weaker tomorrow? And that's going to depend on our consumer price index readings, and I'm going to cover those in just a second. So from a technical standpoint, is it right to still be short? It's not a bad idea. Would I be a little bit hesitant to hold shorts beneath the 62? Not really. We're not seeing a huge amount of participation. So can I confidently say that 115.93 is the bottom of this market? No, I can't say that with 100% awareness. However, I do like what's happening with price. I do like the idea that we're going to test that zone again. We're underneath 116. I think it's still fairly bearish today. And I can tell you this, if you do break beneath that 115.93, you're probably going quite a bit lower. The next port of call for me would be 115.65. So that would be an issue where if you were holding shorts, I would probably green light it, but I would definitely be aware of what's happening right there at 115.93 by today's close. If you don't take that out and maybe close beneath that level, then we could be in for a bounce tomorrow, but a lot of that's going to depend on CPI. Even the London session, everybody's going to be talking about the consumer price index. Be very, very careful there. All right, let's take a look at one more thing here on the Euro USD. We've got some good support levels. Is there an opportunity maybe to short? Not really. 4-hour chart. I love the 4-hour chart on the forex. I mean, it really is one of the strongest in my opinion. But what you have going here, nice bearish, I would say a bearish break. I wouldn't call it a bearish trend, but you've definitely been negative. You've definitely been negative since yesterday's open, the Sunday electronic open here in the States. And you can see that, do we trade beneath that 62% level? I think if we do, we go much lower. I really do. So if you're short, I don't hate it. I like it. You're on the right side of it today. But as far as what we should be looking at later in the day, that 115.93 zone is key. You would love to see a daily close beneath that. If you got that, then you could really start planning on maybe taking a position. But remember, CPI will shake this market up. You don't know what it's going to do when the CPI number drops. You really don't. Let me see. Tina Jing, 116.40 entry. Yeah, so you're already 38 pips in the green. I can't tell you what to do. I won't. I can't give you trade. I can't give you trade advice. So you just have to make the decision as a trader what you want to do. Are you trying to play for that big home run winner? Are you waiting for the big time payoff, or is it worth maybe taking the profits now or towards the end of the day, maybe ahead of CPI, or do you move your stop loss to break even? I don't know. Those are your three options, though, right now. You either take the money, let it ride, or move to break even. I don't necessarily know what the right answer is. I just would really cringe if you were holding a profitable position and gave it all back because CPI came on here. Like I said, we'll be back here in 18 hours. Things are going to get pretty dicey during that London session, probably quiet more than anything. So I really don't know what I would do. Depends on my money management, depends on my leverage, depends on my cash situation, It's in the green. That's all I can say, so it was a good call. Let me see. We had a question here. Hamu, gold and silver are in a corrective move today. Is the USD going up as the euro and GDP, Great Britain pound are also down with the indices? Yeah, I mean, the indices, I don't count this as any kind of move at all. The indices are down slightly, but the U.S. dollar, let's go ahead and take a look at the DXY. I hope that helps on the euro USD. The DXY is interesting. This is a fascinating chart right there, the 10th of August, yesterday. What is that? That's going to be your opening 4 hours, right? Boom, right there. That's your opening 4. Fascinating stuff. Fascinating stuff. What does that mean? It means you had a tremendous difference of opinion when you went up to 99.32, and then you came right back down. That's a long-legged doji if I've ever seen one. I mean, look at that thing. Holy cats. So where do we go from here? What do we want to do from here with the dollar? How can we grade the dollar? What is it doing? Well, let's go ahead and step back. I love the view from 10,000 feet is typically prettier than the view from 2 inches. So let's go ahead and look. What do you have? You have a nice bearish monthly trend. No question about it. Corrective month in July, and that's because Jay Powell was saying, maybe we won't cut interest rates at all this year. That was the idea. That's why the dollar got that bump. Now you're starting to settle in after we saw the jobs numbers. The big jobs saga was huge, and now we're starting to think that we are going to get that interest rate cut to stimulate economic growth. Well, spike high right there, spike low there. Where's your pullback zone? Pullback zone's right around 101.65, and you've also got a 13-month EMA. So as far as I'm concerned here with the U.S. dollar as a whole, I'm still bearish, incredibly bearish. Nice big move. As long as we're beneath 38%, we want to be thinking to the downside of this market. And as soon as we take that out, we've got our 13-period EMA right up there at 102.04. That's a great resistance zone. And really, that's where the fight will sort of ensue up there right around 101.65. Now, as far as what's happened this month, you had a high in July of about 110. That's very, very interesting, isn't it? 100's our key level right there. What happened in August? We started off, we tested just a few pips above that 100.10 level. We went up to 100.25, and we really just took it out by a few pips, and now we've plunged almost 200 pips. That's called a failed auction. All right, that's called a failed auction. And if you guys are familiar with the whack-a-mole game, it was an old video game. You go to the arcade, and the little mole that sort of looked like little gophers or little squirrels would pop their heads up out of the holes, and they would get hit with a hammer. That was the idea, was how many you could hit with the hammer, and that's how you would score points. I really look at failed auctions like whack-a-moles, especially when you're talking about bids. Right there, the high. Everybody knew the high. Everybody in the world knew the high from July. I mean, we all knew it. I knew it. You knew it. Everybody knew it. 100.10. We all knew it. So the question really was at that level, are we going to buy or are we going to sell? Now, typically when you see a trend like this, a big downtrend, you get a washout as soon as that symmetry breaks. There's no question about it. Right here, you did push much higher after you took out June's high. Okay, so June, July, then bang, what do you got there? You've got just a few ticks of a test. The whack-a-mole, the hammer came down, and now the bears are winning. Does that mean that we're going to go lower or higher? It all depends on our interest rate expectations as this month goes on going into September. It really does. But for me, it would not shock me if we get a real hot CPI number tomorrow, which we very well might. If we get a hot CPI, you can see this rally, and that'll be my key level there for the DXY. A lot going on right here. Team Marina whack-a-mole. See, you know exactly what I'm talking about. Absolutely. Lebo, good to see you. Happy to be here. Happy to have you. All right, guys, let's go ahead and talk a couple things. We want to talk about the key events for this week and what could possibly be impacted. This is the biggest event we've seen in a long time when it comes down to just global geopolitics. There's no question about it. And there is a meeting scheduled. There's a Russian United States. It's a Trump-Putin in-person summit scheduled for Alaska. Friday, This is probably the biggest geopolitical event we've seen in a long, long time. Now, there's a lot of things that are happening right here behind the scenes. I'm not going to play conspiracy theorist, and I'm not going to pretend to know exactly what's happening. Here's what we do know at this hour. Trump and Putin have a deal in place. Supposedly there is a peace deal there, or at least a pathway to peace. Depends on what you believe or who you believe, whatever. But Trump and Putin are going to show up supposedly, and they're going to have a summit. Now, right now, they're talking about getting Zelensky involved with that. Now, just the photo op is going to be interesting. It's going to be fantastic. I mean, just this headline right here: Trump invites Putin to set foot in America. I mean, the summit being held in Alaska is really monumental, and just the photo op and how this thing's going to look is going to be something worth watching. Will it impact the markets? 100%. If you see an end to the Russia-Ukraine war, which most energy traders are already sort of jumping on that, you immediately will see a pullback in your energies. Commodity energies, they're going to come off in a big way. You're already seeing it in natty gas. Natural gas is printing 2.9, down big, down 1.63%, and it's been absolutely hammered since traders believed that there was going to be a peace deal in place. So if we have peace, which is something everybody wants, I think I can speak for everybody when you want peace. Key level of 45,000 in the US 30. I think that you're going to get your breakout above that zone. You can see last month we went right up there and hit 45,000, sold off. This month so far has just been an absolute doji fest. We haven't been able really to establish any kind of ground. And why? Because we're tight. I mean, this right here is a textbook reason why I use Bollinger Bands to determine what exactly the state of volatility is and what exactly the market's doing. I know when the Bollinger Bands are sloping, I know we're trending immediately. This upward slope, immediately I know, okay, we're trending. We're outside of the upper Bollinger and we're trending. And also the volatility. As the Bollinger Bands spread out and they open, my volatility is greater. That tells me, okay, I've got a lot of opportunities to trade here. Now, when the Bollinger Bands tighten up and they become parallel with one another, that means that Elvis has left the building. It means that the market's flattened out. You're in rotation. It's moving from left to right, not from down to up or up to down. That's important to understand because when we're in flat markets, we've got to understand that trying to play trends, it's a suicide mission. You can't get it done. There is no trends to be had here. There is no trend to be had here. Now, long-term trends, we could pull it up and say, yeah, we're bullish, 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 but you've got to have a move before you can buy into this market. So just to buy right now, I wouldn't do it. I think that's incredibly high risk. I wouldn't do it. This is choppy. Now, it's one of the reasons why I came in and said, negative 163 points from the Dow, means next to nothing to me. It doesn't mean anything. It's flat. This market's been flat for weeks. Well, not necessarily weeks, but it's been flat since the 1st of August. Nice big sell-off, rebound, flatline. That's indicative of a market that's waiting for a driver. Tomorrow's CPI is one of them, and then the Russia-Ukraine war has got to be a second one. All right, we got a few other things to cover here, but this right here, 45,000 is the key level for the US 30. Have an eye on it. I think that if you get a piece, you're going to see lower energy prices. If you get rate cuts on top of that, if you get peace and rate cuts, these markets are off to the races. You'll have probably the US 30 at 50,000 by the end of the year if you get those two market drivers. If you don't, then you won't. Then we'll just trade sideways, and we'll keep sort of doing what we've been doing really all summer long. So that's definitely a look at the US 30. Sorry, I got to get a sip of coffee. We got quite a bit left here. Okay, guys, key events here. RBA interest rate decision coming across the board later on tonight during the U.S. overnight. It's going to be during that Tuesday session. So if you're in the U.K., you probably are going to want to be watching the RBA. The RBA is expected to cut interest rates to 3.6% from 3.85. This has been the global routine. I won't say the global routine, but definitely the global stance has been dovish. Pretty much everybody but the United States has decided that they were going to start cutting interest rates, and you guys know that's really led to just a political firestorm here in the United States. So we're expecting a rate cut there out of the RBA. What's that going to do to the Aussie, the Australian dollar, US dollar? Well, you can see just how tight life is here. Monthly chart, very, very tight. We've been, decent ranges for the last couple of months, but really the last 3 months, not much has happened. And that sort of seems to be the pattern for 2025 going back to January. 3 tight months, big month in April when we had all the tariffs and the trade war hysteria, and then we rose, and then we've been flatlining about the last 60 to 90 days. So I would work a quick Fibonacci and look to do something like this. I would love a pullback down there to 63.5. That would be brilliant. brilliant. I don't think we're going to get it. As far as taking a position on this market, though, short or long term, I wouldn't do it. I would be holding off. This is what we call a non-committal technical area. And even though the range is significant for the month already, I would be very careful trying to predict a breakout. That's the thing about breakouts. Boy, they get us in there, they get us excited, and then they just never seem to develop. But that retracement zone for the Aussie is a pretty good one. You can see right here on the daily, we're just sort of going back and forth beneath the Bollinger Bands. Boom, boom, pull back, test, down, boom, bounce, rejection, boom, bounce. What does that tell us? With that trajectory of Bollinger Band, meaning we're sort of flat, rotation's tough to trade. You need a market move before you can trade this thing. So I would probably pass on the Aussie other than getting a big move down to 63.52. One other pair I want to talk about, though, briefly is the Australian dollar, the Australian dollar, Canadian dollar. The reason why I would be sort of targeting this Aussie CAD is because of the market drivers. RBA is going to shake things up. We know that. All right. What else, though? Crude oil. Crude oil is big for the Canadian dollar. Canadian dollar is what we call a COMDOL, all right, which is a commodity dollar based on really the price of fossil fuels. They have a tremendous impact on the Canadian dollar and how it goes. All right, so what can we really say about the daily chart here for the Aussie CAD is, do we have a trade? And I would say, yeah, we got a couple of trades we could look at. Number one, you have a double top up here. You could definitely be aware of as potentially topside resistance. Your top right there, that spike high is about 90.22, and that spike high right there is 90.15. So that 90 area, anywhere between 90 and a quarter, maybe 90 even, and 90 and a quarter, probably pretty darn good resistance up there. That could be a potential area to short the market. As far as what we could be looking at right now to bid, very difficult to throw a trade idea out for the long side just because we're at 89.81 is our daily high, and you're right there, you're 89.75. So I would be careful with that. If I was interested maybe in getting more aggressive with something like the Aussie CAD, we could easily go down to our 920 crossover strategy and go ahead and pull up a 4-hour chart and see where we're at. Okay, you can see that we've been long essentially since the 5th of August, and it's been a very good trade. That long trade would have been at 89.41, and right now you're tracking about 89.74. Are we bullish here? Fairly bullish, but this is a grinder. This is really tough. I mean, it seems like every time you get a rally, you sell about, 2 inches forward, 3 inches back, or 2 inches forward, 1 inch back. This is really a tough type of a scenario to hold. You've got to be very confident in your long. I do like the long, though. I think that it's probably the right way to be here just because of the way the crude oil is fading and the Canadian dollar sort of responding accordingly. But take a look right there. What do you have? There's your daily buy. 920 crossover daily buy. Do we send them? It's high risk. Why is it high risk? Because the Reserve Bank of Australia is going to shake this thing up. It's going to shake the Aussie up. I do like the bearish side to the crude oil. I feel like we're getting ready to make another big leg down beneath that 64.50 zone. We're trading about 64 right now. It really does look to me like you're going to get a big gap down there out of WTI crude oil. We're just sort of waiting when. And I think that once they officially announce a peace deal and an end to the Russia-Ukraine war, if that happens, I think that's when your crude oil really we get down into the 50s. We get down into the high 50s, maybe the mid 50s, and we start talking about lower energy prices for a while. But this long right here, you could definitely hold. You just got to be aware that RBA will shake it up, this Aussie CAD, and then something like this. You got sort of that horizontal line we dropped for our stop loss location. Be right down there beneath that swing low. You could put it in here if you wanted. I don't think it's that big of a deal to put it a little bit lower, 88.75, and then right up there, what your longs right around 89.75. So about 100 pip risk, and you're going to need this market to get up and take that double top out. Is it worth it? Could be worth a stretch if you wanted to shoot for something way up there, maybe a 1 to 2, or just take a position. Could be. It's possible. I believe that the interest rate cuts are already baked in to the Aussie. So I wouldn't be too shocked if this market actually went against conventional wisdom and you got the rate cut and it rallied. Let me see. Samson, I've decided to completely stay out of the lower time frame, but this your 920 EMA is attracting me to go back. Well, if a person was gonna trade the 920, and I've said this on a lot of our live webinars and tutorials that we do on the 920, it's one of my favorites. I really like the 4 hours in the dailies. I mean, I really like them, but I understand that the stop loss locations are a challenge. I mean, that's 100 pips. That's a position trade. Your stop loss is 100 pips, and you're going to have to deal with your swap fees. I completely understand that if you don't have the type of capital to trade that, then you can't really trade it. I understand that. I get it. For me, though, I mean, I think in terms of all the opportunities that are out there to get funding, I mean, in a prop type of a situation, if you have a prop firm that you don't have to liquidate your positions at the end of the trading session, which is kind of it's a brutal rule. They should let you position trade. But if they make you liquidate, then that's tough. If they let you carry swing trades and positions, this 920 daily and 4-hour chart's definitely worth looking at. Definitely worth looking at. All right, guys. One more last big thing. CPI. We're going to have CPI live for you tomorrow, so be sure to get back and tune in. We're going to have pretty much everything you need to trade it. I'm going to give you our expectations. I'll cover those again tomorrow morning. I'll also cover our Fed interest rate expectations and what to think about there. But we're also going to really unpack, what this CPI report means after it drops. And once it drops, we got to really see what happened, because this is a high pressure situation. This can derail all of our expectations. This could make a September rate cut, which we think right now is going to happen because the jobs numbers were so terrible. If this CPI number comes in big, and I mean big, like a lot of us were ready for it, if it does, then that rate cut is going to come. The odds of that rate cut are going to come off the table in a big way fast. So always remember this. A central bank has two things that it has to do: promote maximum employment and promote pricing stability. That's the only two jobs Jay Powell has, and they can't do it. They haven't been able to do it. The employment side of the equation has been pretty good. Really has been pretty solid since COVID. We haven't seen a big pullback like a recession would bring. We're starting to see some of that now, but not really as bad as it's been in the past. And the other part of the equation is pricing stability. Prices have been high. The inflation's entrenched, and they haven't been able to do anything about it. And a lot of it, in my opinion, was the rate cuts late last year. I thought they were a horrible mistake. I thought they were premature and politically driven. I think everybody thinks that now. I mean, a lot of analysts, they won't admit it. They can't say it on TV, but I'll say it here. I mean, there's no way you cut a half a point before the election with prices where they were, and then cut again another quarter point in December. You can't do that and then turn around this year and go, oh, it looks like we made a mistake. I'd say prices are as high as they've been. Now, we can blame tariffs and we can do all those things, but the evidence isn't there that it's because of the tariffs. We know that we're still fighting out of COVID-19 and the unlimited quantitative easing. That's the truth. Now, what does this set of numbers mean to that? It's big. It's huge, because this round of CPI numbers is going to really dictate what we're thinking for our rate cut in September. That's what we're expecting. Core CPI is expected to tick higher month over month, 0.3% over 0.2%. All right, and we're going to focus on the monthlies here. And then CPI month over month for July is expected to retrace a little bit, 0.2% from 0.3%. Now, remember, these are growth numbers. It doesn't mean that prices are coming down. It just means they're not rising as fast as they were. CPI growth, prices have been on a rocket ship, really going back to COVID. This is a good look at your monthly look at your raw CPI index, your raw CPI data. And I'll tell you what, right now, that's not good. That's not good. That's an all-time high. This is an explosion of pricing since December. Your half a point rate cut came then. Quarter point rate cut came then. And that really set the stage for an ugly 2025 as far as consumer prices go. You can see back last year, it looked like this was under control. It wasn't. It wasn't. So this is an interesting type of a chart. We're going to be watching this closely. What does it mean? It means that CPI needs to come in, as expected or beneath expectations, or else you're going to really see a potential big-time pullback in stocks and a lot going on in the markets themselves. One more market, and then we're going to go ahead and kick it here. XAU. I'm almost tired of pulling this chart up, but I have to. I have to, because a majority of the traders on this stream trade gold. I trade gold futures, so there's nothing wrong with trading gold. This is a bullish pennant. I spent way too much time breaking it down for you last week, so I'm not really going to do that again this week. I'm going to give you the broad strokes. What do you need to be looking at? Top side, 3,500 is the high water mark. Have a close eye on that. You've got an inside month. You've got an inside month there. We sort of tested the top of that. We traded inside of the previous month. This is as tight as it gets. This market is gearing up for a major move. Now, last week I really talked about the path for this thing, for gold to go up to 4,000. And what can really happen here is it can also reverse. There's two sides to every coin, guys. You get a peace deal. You get a Russia-Ukraine peace deal. Okay? You get a high CPI number. Those are both bearish market drivers, all right? So when we sit here and we look at this chart and we say, okay, Shane says that if we break up over 3,500, we're going to go to 4,000. I believe that. I really do. But if we get the proper market drivers, maybe higher interest rates or no rate cuts, and global geopolitical stability, gold comes down. And really the first step to that will be tomorrow's CPI figure. If we do see a hot CPI number, meaning way above expectations, you're probably going to see a big-time move in gold. Because yet last week we priced in what looks to be sort of a foregone conclusion right now that you're going to get a September rate cut. I mean, last 2 weeks, we're up probably, about 1.5%, 1.75%, something like that. But we're still flat. So what I'm saying is don't get too carried away that this market's going to just blow up. And trend lines are tricky, something like that maybe on a weekly. You could work from that one. You could also work from this one. This is probably what I would do to keep us absolutely current. You do something like that. This is an ascending triangle, no question about it. We have a lot of these videos in our trading academy at How to Trade. Ascending triangle. This essentially means that we're waiting on something to break. 3,500 is our big deal. If we break and we go above 3,500, we're going way high. But if we reverse out of this and we break this trend line down, then we need to be ready to get into this market to the long. We're still going to be bullish just because of the state of the U.S. dollar. But if the geopolitical tension is gone, spike low right there. That's where we're going to base our move off of. The reason why is because this is a spike formation. This low is beneath the previous candle. It's beneath the subsequent candle. Bam. Spike high. Higher than the previous. Higher than the last. Beautiful. Where are we looking to bid? Right where we've been for months seemingly. 31, 37.50, maybe 31.50. That's a great area to be buyers. Still bullish. Long-term trend still up. But the market drivers suggest that we are in for a move. Think about what this chart says. This is sort of the last thing I'm going to say about gold. Think about what this chart is telling us intuitively. Doji, a little peak above the doji, and then a hammer, sort of an inverted hammer. Those are reversal signals. Both of those are reversal candles. We're inside of last month's range. It means nobody knows what the hell to do with gold. They don't know. They've got to wait for a big market driver. That's either going to be Fed policy or geopolitics. We have the geopolitical market drivers slated for later this week. We've also got the monetary policy drivers. You've got CPI and PPI. That's huge. That's absolutely huge. So this week is big. This week is big. You can see I'm smiling because I know it's game on. I mean, it's game on. So I can't wait. I can't wait to get in there and match wits with these folks. I want to go against the institutions. I want to see exactly what they're doing, read what they're doing, and then profit from it. That's my mindset. I'm coming into this week. It's a great week to be a trader. It really is. This is going to be some good stuff. So tomorrow, CPI Live. I'm going to be here bright and early. We're going to be live. Watch for our Switch Markets newsletter if you're in the UK and a Switch Markets client. That should be hitting your email box sometime early Tuesday, and that's going to give you some markets that I'm going to be looking at. And then it's also going to give you a nice write-up on the key market drivers for this week. Could be a pretty good one. Let me see, Hamu, 3,500 or 3,100. Yeah, a bit of a clear picture after the current week events. I think so. I think that you've got it summed up pretty good there. 35 or 31. Right now we're trading right in the middle of that, 33.50. Believe me, this isn't an accident, guys. Nobody knows what the heck's going to happen with gold, but it is. This is the way markets work. They move, they tighten up, and you get that compression, and then they blow off the steam. Once the steam blows, this is going to be a big move. Just because we've been compressed all summer. It could be bullish. It could be bearish. Depends on which way these market drivers break. All right, everybody. That's enough for me today. Ran long again. I said, come on, Shane, get in and out in a half hour. I can't seem to do it. I guess I'm just a loudmouth and I talk too much, but that's all right. I appreciate everybody's questions and participation. We'll be back bright and early for that CPI Live. Remember, if you're holding these positions into that, be careful. Be careful. There's going to be a lot of action. I'm going to be on 10 minutes before the number drops. We'll go back over what this number could mean, what we're expecting. We'll have some key levels for you going into the number, and then we'll also have probably some live trading, some live scalping. We'll see if we can get a few scalps maybe on the U.S. indices before the open, or potentially maybe one of the majors. All right, guys, that's a wrap. Have a fantastic trading day. Trade the action well, and we'll talk soon. See ya.